The crash in the housing and stock markets is not only imminent, but poised to surpass the financial crisis of 2008 in terms of magnitude and impact. Experts predict that real estate and stock market values could experience a staggering collapse, possibly dropping by more than 40% by 2023. But why exactly will 2023 be worse than 2008? What specific factors are at play? Inflation, the pandemic, rising interest rates, or something else? Stick with us as we break down these concerns. And don't forget to hit that like button and subscribe to stay updated with all things market-related. As I've mentioned, the impending financial crisis looks set to be significantly worse than the one that shook the global economy in 2008. To put things into perspective, the combined total value of the U.S. housing market and stock market reached an eye-popping $80 trillion by the fall of 2022. This is especially alarming when you consider that the U.S. economy, measured by its gross domestic product, GDP, only amounts to about $25 trillion. This disparity suggests that asset prices are roughly 3 times higher than the size of the economy, which of course is unsustainable. Given this, experts predict that the markets could see a 30 to 50% decline before we hit a more stable and realistic valuation based on the actual size of the economy and the income levels of everyday Americans. At present, we find ourselves in what's known as an asset price to GDP ratio of 0.3%. This ratio is crucial to understanding the state of the market and where things are headed. Historically, this ratio has hovered closer to 200%, which reflects a more sustainable relationship between the value of assets and the economy's overall size. To restore the balance, we would need to see both the housing and stock markets correct by a significant amount, dropping prices down to levels that reflect the true value based on the economy's capabilities and consumers' actual incomes. Now, I know it may sound unbelievable to suggest that this upcoming crash could be even worse than 2008, but the data is clear. The current market situation is more precarious than ever. Although asset prices have already started to dip slightly, they remain far above where they should be according to the size of the economy. The real correction is still coming, and it's likely to be larger and more painful than previous downturns. The Federal Reserve's decision to raise interest rates is expected to deepen the recession. This in turn will likely lead to more layoffs and a spike in applications for unemployment benefits. As a result, asset prices will continue to fall until they settle at more sustainable long-term levels. You might be wondering, how can we tell that the situation is deteriorating? One clear indicator is the continued decline in housing prices. We recently put together a video detailing how housing prices are already dropping in 2023. And if you're interested, feel free to click on the card in the top right to watch it. For example, look at Credit Suisse, one of the largest banks in the world, which has been grappling with major financial troubles. The bank is facing challenges in securing capital. Its credit default swap, CDS, spreads are widening as stock prices are on a downward spiral. Investors are now fearing that Credit Suisse could follow in the footsteps of Lehman Brothers during the 2008 financial crisis, becoming the canary in the coal mine and triggering a global financial chain reaction. This is just one example of a warning sign, but it's an important one that indicates the scale of the problems at hand. In addition to the banking issues, there's the matter of the British economy. The new British administration recently announced tax cuts that were significantly underfunded, which could increase national debt by as much as $50 billion. This has led to a sharp rise in bond yields, jumping from 3.5% to nearly 5% in a matter of days. As a result, the country found itself dangerously close to its own Lehman Brothers moment. Investors refused to purchase British government bonds, which led to a sharp spike in interest rates. This, in turn, nearly caused the collapse of the country's pension funds. The Bank of England had to step in and announce it would buy bonds to stabilize the situation. Incidents like these are the early warning signs of much bigger problems on the horizon. They suggest that the global financial system is far more fragile than many people realize. In the U.S., the Federal Reserve's ongoing interest rate hikes are also putting significant pressure on the economy. Combined with rising petrol costs, This could be the tipping point for the American consumer. Data on credit card debt and personal savings rates indicates that the average American household doesn't have much financial cushion left. The savings rate in the U.S. is currently at a mere 2%, which is drastically lower than the long-term average of around 8%. This is dangerously close to the low savings rates seen in the years leading up to the 2008 crisis, as reported by the Bureau of Economic Analysis. With this in mind, many Americans may find themselves in a precarious position, unable to afford everyday expenses like dining out, going to a ball game, or even filling up their gas tanks. Despite the persistent inflation and rising gas prices, we may soon see a deflationary period set in. Prices can only increase so much before they break the economy. OPEC is already limiting oil production, which is further squeezing American consumers and preventing them from spending money on things like entertainment or major purchases. People just don't have the disposable income to handle these rising costs. Given the low national savings rate of 3.5%, the average American consumer may soon hit their breaking point, choosing to cut back on spending even more. So, what does all of this mean for you, the investor or concerned consumer? First, consider how this information might influence your decisions going forward. It's important to think about the practical steps you can take to navigate the upcoming economic downturn. As we move into a likely deflationary environment, cash could prove to be one of your most valuable assets. In fact, even with inflation running high, cash has outperformed other investment assets in recent years, surpassing both the stock market and cryptocurrencies. It has even outperformed gold and silver. And by the end of the year, it's expected to outperform real estate as well. Keeping a large amount of cash on hand is more essential than ever. Not only will it allow you to take advantage of the continued fall in stock and real estate prices, but it will also give you greater flexibility to adapt to changing circumstances. If you're someone who might be laid off in the future, or if you're seeing your hours cut, wages reduced, or facing any other disruptions due to the economic downturn, you'll want to ensure that you have enough savings to cover your bills and make any necessary adjustments. This financial cushion will also give you the freedom to explore new opportunities as they arise. I'm not trying to scare you, but the reality is that we're facing uncertain times, and preparing for the worst while hoping for the best is always a wise strategy. If you're someone who is already experiencing the effects of the recession in your city, neighborhood, or state, please feel free to share your insights in the comments. Your experiences can help others understand what's happening on the ground. As always, we appreciate your feedback and value your input. If you found this video informative, be sure to give it a like and subscribe to stay updated on the latest economic trends. Thanks for watching, and we'll see you in the next video.